Jitendra Goel. He's joining us. He's CIO listed equities at Bajaj Alternatives joining us. Jitendra, great having you. And thanks so much for waiting by very patiently. Let me first start off, Jitendra, with how you're looking at markets at this point of time. Two factions. Risks are still there, but and therefore probably wait and watch. That faction of the investor community seems to be waning. But at the same time, we're not seeing moves on the index. So I'm trying to understand how is it that you're looking at, one, the moves on the index, and second, at valuations currently.
Yeah, hi. Thanks for inviting me on your show.
Great
First
having
of
you.
all, if I look at the macro and the backdrop for equity market, I think market is now going to see some kind of surprise in terms of GDP growth that we have been talking about. So the growth has been a little faster than what market was expecting. Second, it is also reflected in the earnings outlook. Now, whether it is because the inflation has started to move higher and hence we are seeing that impact is visible in the earnings of the company, and that is a good backdrop for overall broad-based recovery. And whenever we see economic surprises and broad-based recovery in the economic activity, then we see the broader market starts to do much better compared to the large cap Nifty index. So overall, we think that some more surprise is possible, especially in the economic data. Example, the banking sector growth is now running over 18%. Auto sector growing at 25 to 30%, and power sector, which is largely driven by government capex and now the private capex also picking up there, that is also showing some 20-30% growth. So overall, I think mid and small caps are in a better position. Obviously, the valuations have rallied after these indices have made new highs. But net, I feel there is more surprise on cards with respect to earnings and with respect to the growth, and where I think the broader market should outperform the large cap indices.
I'll touch upon the macro that you just spoke about, Jitendra, for just a minute or two, because you'll have the FOMC meet outcome this week. I'm trying to understand whether there's a real risk. This US 10-year bond yield at 4.65 odd percent. I mean, there's been a real rally, or rather a real collapse in terms of bond prices. What should one read into as an Indian investor? Will it just delay FIs coming in, which will mean that very likely that a pain from a flows perspective will continue?
I think that's the big question that look, but what we understand from US market is that look, US is now sitting on closer to 40 trillion debt. Their average cost of borrowing is somewhere around 3.4% now. And the interest cost annualized is running at $1.2 trillion. And now if the war continues and if oil prices goes further higher because of some more stress comes up, then it is really a stressful situation. At the time when the AI boom is at the peak, around 800 billion plus dollars of capex that these companies have announced. So net, I think US cannot afford to raise rates any further, and we have seen that whenever the 10-year yield has started to shoot up, Donald Trump comes and tweets that okay, we are going for a ceasefire. So that's very clear in our view that US understands the problem, that look, higher interest rate is extremely detrimental for the AI capex and the way the growth is panning in US. So it's very fragile growth that US is sitting. If interest rate starts moving higher by 50, 100 basis point from here onward, then probably the capex and the story for US is over. So we don't see that Fed is going to tighten at this point of time. What we think is that, what we believe is Fed is going to talk hawkish but act dovish. What I mean by that, the governor might just say that look, we will not be able to tolerate higher inflation, but on the paper they might talk about, but in practical, I think US will try to keep the interest rate where it is, and market knows this probably. And if I look at what is the impact for emerging markets now, already the yields whenever it starts moving higher, it is detrimental for the emerging market flows. And this, coupled with the AI trade, which is highly concentrated in few sectors and stocks, is started to peak out. And what we have seen in the past couple of weeks, that FPIs have started to look at outside United States. And this is just an initial sign. I'm not saying this is a trend, but at least there is this view that look, this AI rally has done significantly better. And plus now the Chinese companies are also coming in the market with cheaper bundles. So net net, I think US companies are going to see more competitive intensity, and this pressure is going to lead to fund manager reallocating their bets away from the US market. And this is just a sign that we are observing. But net net, I think we will see that money should starts to diversify away from US. And India tends to benefit when that happens, because India is a broad-based market and kind of a flight to safety. Whenever that happens, then probably India will see some kind of inflows. And valuation is also now reasonable. It's not extremely stretched that we have seen in the past. Obviously, some pockets are extremely valued, but still, I feel that if there is a rotation, then India will definitely benefit.
Interesting. Okay. And therefore, in terms of flows, if flows were to reverse, uh, what would be the sectors which could benefit the most? Would it be the traditional ones, IT and banks? And if so, banks, I mean, in general, look cheap. I wonder what your view is and what's the view on IT?
So overall, see, if FI comes, then definitely large caps will benefit. But in terms of earnings trajectory and the kind of sectors that India is witnessing, significant flows, I think that is still a mid and small caps. So overall, if flows come to India, then all the sectors will benefit. Out of that, initially, probably you will see some short covering happening in IT and bank sector, where there's valuations have come to a very reasonable level, and those sectors tend to see some kind of a pullback. Now, in terms of banking sector, we are still very selective. We are not seeing that you should go broad based and buy all the banks, because the competition is rising in the banking sector. Overall, we see that while the growth has been surprising, almost 18% growth in credit, which is phenomenal. But on the other hand, we are seeing the margin compression happening in this sector. So net net, I think if FI turns positive on India, probably banks and IT are the two sectors which will benefit the most. However, if I have to take a broader view and where I see next, let's say 6 to 9 months, I would say that consumption, which has been on the sideline, has started to pick up. And we have started to accumulate some of the stocks which are going to benefit from. First is UP election, which is sometime in March next year, and also the eighth pay commission. We expect this festive season also could be better. Looking at what happened with auto sector, almost 20, 25, 30% growth. And now, if you understand the results, if you look at results very closely, there is a clear surprise. So rather than auto, gems and jewelries, for example, almost 50 lakh people are employed in gems and jewelries. Despite all this headwinds, we are seeing that that segment, some of the niche companies are doing phenomenally better. Outsourcing of designing and all is happening in the sector. So we are seeing that that niche is doing pretty much stronger. Even diagnostic companies have started to perform better. QSRs, quick service, restaurants are seeing growth acceleration. So there is this positive momentum building in the consumption sector, especially on the discretionary consumption sector. I think next 6 to 9 months, these sectors will tend to perform better in our view.
Hmm. Okay. And Jitendra, let me try and dissect this a little bit more. With regard to IT, from a structural standpoint, are things going to change dramatically? Should one be worried?
So, in terms of ITC, first is valuation, right? So, valuation is definitely attractive. I've seen this large cap IT companies trading at 22, 25 times, and now it is trading at 12 to 15 times P ratio. Dividend yield is also attractive. So if you're a value buyer, value conscious, and you are okay with a 8-10% kind of a return, then IT provides a very low downside from here onward, and medium to long term, probably they will change their business model. And it's not the first time that this industry is under pressure, right? Whether it was after dot-com bubble, people thought, now that game is over. Then we saw cloud, game is over. But now you see that the companies, tend to diversify, bring more businesses. So net, I think the sector is beaten down very badly. So in the near term, probably we'll see some bounce back. From a structural perspective, what we are hearing is that, look, they have to change their business model. They cannot continue with the same business model. And the AI part, or if you see that the sector and the segment that is benefiting from AI trade and technological advancement, then that sector is somewhere growing at around 20 to 30% for the IT. Obviously, with respect to top line, it is just 10% of their overall top line, or 15%. But net, the larger portion, which is 80-85% of their services business, traditional businesses, is showing price erosion. It's very difficult to retain clients. So it's a matter of time which company actually takes the lead and try to grow the business, which is expected to grow around 20-30%. So I would say that it's a good time to accumulate, but don't have a short-term view here. If you are a really patient investor, probably you will see that IT is a good time. I don't deny it can even trade at 11-10 times if a couple of years it grows in the negative. But on the other hand, the rupee is also depreciating. So you are getting that kind of a tailwind. And I think here it's a 50-50 kind of a call. But I would say that from a near term perspective, you might see some pullback happening in the sector.
Okay, Jitendra, thank you so much for coming in and giving us that perspective.
Thank you.